investment appraisal, that is the one of the core topic area. And investment appraisal, one of the biggest section of the syllabus. And investment appraisal, we can categorize into 3 sections, further subsections. The one is investment appraisal techniques. Second, adjustment in the investment appraisal. And the third one is, that is decision making, application of investment appraisal. Application of investment appraisal to make decisions. So 3 sections are there. Investment appraisal techniques include 2 types of techniques. The one is called discounting techniques, and the other are called non-discounting techniques. Non-discounting techniques. So the name tells its story. Non-discounting techniques, which are not talking about time value of money. So ignore time value of money. And they consider time value of money. Now, so discounting techniques and non-discount. Non-discounting techniques are 2. ARR, accounting rate of return. ROCE, return on capital employed. And the second is, that is simple payback period method. Simple payback period method. So 2 techniques are there. And non-discounting and the other techniques, discounting techniques, they are start with discounted payback, NPV, IRR. So these are part of your syllabus of financial management, F9. Now, so one by one, a quick revision. Accounting rate of return, ARR, this is the technique which is the only investment appraisal techniques. That is the only investment appraisal technique which is profits based. And we calculate accounting rate of return. The formula is there, that estimated average annual profit of the project which we are forecasting divided by average investment into 100. So percentage, answer is in the percentage. So accounting rate of return of the project is calculated with this, which is called ROCE, return on capital employed as well. So average investment, where average investment is calculated. How? Initial investment plus scrap value divided by 2. Sometime examiner specifically ask you that don't use average investment. They ask you use initial investment in the denominator. And then the formula here, instead of average investment, we utilize initial investment. And it is done only when examiner asks you to do so. Otherwise, this is the preferred formula, average investment. Now, so the company, the board of directors, they decide a method. They decide a rate that, for example, the board of directors, they decide that, for example, 30% ARR is acceptable, not less than that for any project. Then we will accept that project. So this is the target ARR, which is decided by the board. So if ARR of project is greater than that or equal to that, so we say accept the project, otherwise reject the project. So it has major drawbacks. What are the drawbacks? The drawbacks is that it is profits based. Profits based, which are subject to manipulation. Profits can be manipulated by using depreciation, amortization, non-cash expenditure. So profits based it is. Second, it is a relative measure, percentage based answer. It is not telling the exact amount of profit, exact impact on the shareholders' wealth. So it is relative measure, and a relative measure, how much is the impact? It is not. It is telling in the percentage. So a project which is having small profit but high percentage may not be acceptable, practically speaking. But ARR is saying accept that because has a high percentage. So it may give such decisions which are actually not in the beneficial of shareholders. Now, the second is the simple payback period method. Simple payback period method, this method of investment appraisal. So simple payback. Simple payback, it talks about that in how much time initial investment of project will be recovered. Recovery, its main concern. So that's why it is called a screening devices, screening method. Because investor is, first of all, interest is how much time it will take to return my initial investment. If that is not acceptable to me, I will not accept the project. Simple is that. So how it is calculated? It is cash flow based. Again, all other methods are cash flow based. Only one method is profit based, which we are talked about. Now, simple payback. So simple payback is actually how it is calculated. That, for example, we say that payback of a project is equal to initial investment divided by annual cash flow. For example, a project has initial investment of $20,000. An annual cash flow to be produced by the project will be 4,000. What will be the payback? Very easy. That 20,000 divided by 4,000. So 5 year. In the 5 year, project will return its original investment. Now, the point is whether a project is acceptable or not. Again, so target payback the company has. So payback of a project, if payback of a project that is equal to or less than that target payback, we say accept the project. Accept the project. Because investor wants the recovery of investment within planned time frame. Even sometime for the sake of returning the loan to the bank, we need to know then how much time we can withdraw our money from the project and return it to the bank or make available for further investment. So that's why. So payback. So again, target payback, it is again decided by the company management. Now, but sometimes cash flows are not that straight. There are uneven cash flows, means not same every year. Practically speaking, the cash flows varies over the year of a project. They may not be same. So for example, a project has this cash flow. This is the time T, and the cash flows are initial investment is 20,000 and 4,000, 5,500, 6,500, and 4,500. So now how to calculate the cash flow of this project? How to calculate, payback of this project. So we need to create another column, cumulative cash flow column. We need to create another column. cumulative cash flow. Cumulative means total to date. So 20,000 negative, 4,000 recovered, remaining is 16,000 negative. 4,000 recovered out of 20,000. Then 5,500 recovered. So 10,500 negative remaining. Sorry, 5,500, yes. Then 6,500 recovered. So the remaining is 500 negative. 4,500 negative. No, it is 4,000. Yes. And now we need how much negative? 4,000. Here there are 4,500. So 3-year complete plus part of year 4 will be utilized to calculate payback period of this project. So how much part? 4,000 we need. There is 4,500. 4,000 we need, and there is 4,500 in year 4. So part of that will be utilized. Okay, so that can be calculated 3-year plus. So we need to calculate on this calculator. Just 1 minute, please. I'm opening that calculator here in front of you. Yes, you see here, 4,000 divided by 4,500. 0.89. So 0.89. So 3.89 years is the payback period of this project. And now we need to calculate, we can calculate in the months as well. So 3-year and how many months? So 0.89 into 12 months. So we can find that. So that is equal to into 12 months. That is equal to 11 months, 10.6 months. So 3-year and 11 months. That is the payback of this project. So if the cash flows are uneven, they need to calculate payback period like this. Now, so students, payback period. What are the advantages and drawbacks? Advantage is that it is cash flow based. So cash flows are not easy to manipulate. They cannot be. Cash in and cash out. Simple. That need to be net cash flows to be calculated. And then it actually reduces risk of company. How? It encourages accept those projects which have shorter payback. Accept those projects which have shorter payback. So it actually reduces the risk of company. But it has some drawbacks as well. Drawbacks is that, first of all, time value of money. It is not considered. It is not discounting. Not at all. Second, it ignores the cash flows after payback period. Or we can say it does not consider full life of project. Full life of project is not being considered. It is concerned only when our investment will be recovered. 3-year, okay, that's it. What will happen after that? It is not concern of this payback period, and which is not good. Okay, and the third point that is it may create short-term focus of business. That accept all those projects which have short-term payback. So the long-term focus may be ignored. The payback period. Now, so there came afterwards discounted payback period method. Discounted payback period method actually removed this drawback, time value of money issue of simple payback. So it actually started doing the discounting of cash flows first. Now, so come here. So, for example, a project is having these cash flows minus 15,000. It is the outflow, initial investment in the timeline. Then 5,500, 3,500, 4,000, 4,700, and 5,200. These are the cash flows of the project. We need to calculate payback period of the project. So we need to calculate simple payback. So cumulative cash flow we will calculate, and then we will calculate simple payback. Simple is that. But if we need to calculate discounted payback, we need to know what is the discount rate. For example, that is 10%. So we need to apply a discount factor at 10%, which is 1.909, 0.826, 0.751, 0.683, 0.621. You can see this from the discount table. It will be provided to you in the exam platform available to you. Now we will calculate present value of cash flows. We will calculate. So 5,500 into 0.909. Yes, 4,999. 5,000 you can see. 5,000. And here it is 15,000 negative because it is multiplied here. 3,500 into 0.826. 2,891. Okay. Now 4,000 into 0.751. 4,000 into 0.751. Sorry. 3,004. 4,700 into 0.683. 3,210. And the last is 5,200 into 0.621. 3,229. So these are the cumulative present value of cash flows. We need to calculate it while calculating discounted payback. So now it will be multiplied. Now cumulative cash flow column, we will make cumulative cash flow column on this present values. On these present values will be created. So negative 1,500, 5,000 recovered, negative 10,000. Then 2,891 recovered. So 10,000 minus 2,891. It is recovered. 7,109. Remaining, then 3,004 recovered. 4,105 remaining. Then 3,210 recovered. 895. You see here, 4 complete years have been exhausted and we have not recovered our full investment yet. So 4 year. Now part of year 5 will be utilized. So plus, this is what we need. Divided by 3,229. So divided by 3,229. 0.28. So 4 year plus. So 4.28 years is the discounted payback of the project. So how many years? 4 years. And so 0.28 into 12 months in a year. 3 months. That is the discounted payback. Now, discounted payback has all other drawbacks and advantages same as that of simple payback. Okay, only one drawback is removed, that it is considering the time value of money. Now the next point which I want to explain to you people, that we talked about the cash flows and profits. Students, when cash flows are given, if we deduct from them non-cash expense, so then that is the profit. Do we get profit? This is the linkage between profit and cash flows. Profit and cash flows. So, for example, we can rearrange this equation as well. Cash flow, if we want cash flows, profits plus non-cash expense plus non-cash. So that is, we get cash flows interchangeably. This should be very much clear. Now, so students, why I have discussed it with you? Because sometime you need to do it in the exam. For example is that you have been given cash flows of the project. Cash flows, this is the year, and the cash flows are here. That is 5,000, 7,500, and 9,000 and 10,000. And you have to calculate ARR, initial investment of the project. For example, that is 20,000. Scrap value is 2,000, which is at the end of the project life. Now we need to calculate profits to calculate ARR. How to calculate? Very easy way. So we need to calculate total cash flows. Sum all these. 5,000 plus 7,500 plus 9,000 plus 10,000. 31,500. Now we need to calculate total depreciation, non-cash expense. How to calculate? Initial investment of the project is 20,000. At the scrap value is 2,000. So the difference is the depreciation. It means this difference is depreciation. That is depreciated through the life of the project. What is that? 18,000 here. So 20,000 minus 2,000, that is equal to 18,000. Yes. Now, so we have to calculate now profits. Total profits of the project. We have learned the formula above. How to calculate profit? Cash flow minus non-cash expense. So cash flows minus non-cash expense. That is the problem. But here another problem is there. In the cash flows, in the final year, scrap value is included always. Scrap value is not part of the profits. That is part of the cash flows. So we need to deduct that 2,000 as well. So total profit. Okay. So this 2,000 came from this scrap value. This has to be deducted in the final year. So now it will be 11,500 total profit. So average annual profit we can calculate now 11,500 divided by number of years. Average investment we can calculate. 20,000 is initial investment, 2,000 is scrap value, divided by initial investment plus scrap value, divided by 2. We have learned it. This one. Okay, now. So it is now. This can be calculated and this can be calculated. Now put the figure in the formula ARR, average annual profit. Here, for example, it is X, it is Y. X divided by Y into 100. This will be the answer. I hope you got the idea how to adjust the cash flows to get profits and hence ARR. So, more videos are coming your way. Thank you.